Hello, everyone. Welcome to the Nasdaq Dorsey Wright podcast for the week ending on October 3rd. I am Ian Saunders and joined here by Miles Clark. Miles, good to be here with you.
Hey Ian, how's it going? It's been a bit since we've been on. I think maybe 3 weeks,
It
maybe
has
a month.
been. You've been traveling too much. I think you've been avoiding me.
I know I made the joke last time. I'm going to make it again. Mr. Worldwide, they call me. I'm like Pitbull with a bald cap on for next time. You know, can keep all my hair here. But
Yeah,
anyways,
that's the
yeah,
way we have the hat here for a reason. Yeah, no, it's been good. I mean, it's got to be good to get on the road, see clients.
yeah.
Yeah.
Oh yeah, and it's good to talk to people about the gospel at its point and figure. How momentum's doing this year, and utilizing it in your practice. So always nice to go out and see how the site is impacting people in their book.
Yeah, it's funny. September rolls around each year and it's like everybody's back to school and back to
And
traveling.
they're off
I
the
mean, I
beach.
was I was in the airport myself a week or two ago and it's like it was busiest time I'd ever seen Atlanta Airport. It's crazy out there these days.
And you and I were talking about it before. Busiest time at Richmond. Is it like 11:30, 12 o'clock at night when you come in and you're like, I thought, everyone's supposed to be in bed. No, the Richmond airport is probably about 6,000 people. The whole city of Richmond is going through.
That's crazy.
Anyways,
Yeah. I mean, and looking at movement though, so if we're recording this on October 1st, we got a pretty important piece of research coming out today, right? It's the what we call weight of the evidence,
wait to the
Q4 2025, an initiative that actually you pioneered a little over a year ago?
about a year ago. Time
About
flies.
about a year ago. It's kind of crazy now. Yeah, we put out several of these. We do it quarterly, try to get it out as close to the start of the quarter as possible, and it's coming out the first day of the first quarter, so pretty good. We hit that bullseye. Before diving into that though, I mean, you said you have any of the performance up? How everything's
Yeah, I
been
mean,
looking?
what out of the names we typically look at, $5 is on the line here, Ian. What's the best performing name that we've seen so far in the year?
In the year?
Yeah, so far this year.
Whew, gold.
All right, I owe you a sandwich or something like that. Gold up nearly 50% so far this year. Pretty crazy, right? When you think about that, at 46.08 so far this year. The next highest name, double or nothing. What's the next highest name?
The next highest name, emerging markets.
All right, you have $10 to spend. Emerging markets is second. We won't triple it or nothing because you're on a roll, but EFA rounding out the top three.
Would have been my third guess.
Very strong year across the globe,
Yeah.
across a lot of stuff. And that's not to say, typically when other parts of the globe are doing well, you might not expect the same from the domestic market. But the S&P 500 up almost around 15% so far this
Yeah,
year.
double-digit year for domestic equities, most broad indices, especially on the cap weighted front across the board on the
Right.
domestic side. Outperformance from international, outperformance from gold. I mean, a lot of stuff moving higher. We won't even get into Bitcoin and all that stuff.
Right.
But I think at the end of the day, that's was probably unexpected heading into the year. I mean, we gotten really a couple of years of really strong performance from especially the S&P 500, QQQ, the cap weighted Mag 7 oriented stuff. And everything's up. If the other stuff's going to do well, that stuff has to fall out of bed, right?
Right.
Not necessarily. Maybe it just won't do 25% a year.
Right.
Maybe it'll do 15 or still could do 25. We'll see how the
Who
fourth
knows?
quarter shakes out. There's still a lot of time for a lot of action to happen. But I think it's been a pretty interesting year. And when we're looking at a lot of movement throughout the markets, one of the pieces that we look toward are as we enter October, October tends to be a pretty interesting month, right? We tend to see a lot of volatility in October, maybe not necessarily on a intra-month basis. Like the month of October can be volatile sometimes, sometimes not. But in terms of the spread between the returns, October tends to be pretty good or pretty bad, not a lot in the middle.
Right. Yeah, you think about kind of the average of 1,000 and 0 is 500. I don't know exactly where I'm going with this, but the point is that within October you get pretty big extremes. You think to big market meltdowns, right? 1978, 1987, late 80s, 2008, all of those kind of accelerating declines in October, but there are also just as equal kind of strong months in there to kind of offset those. So on average, October, a slightly positive month, but again, that's the average. And so, the first hurdle for a lot of these major markets as we look to kind of end out the year on a high note is kind of getting past some of that volatility and making sure we're on the plus side of October.
Yeah, and as we're heading into this October, and we've gotten pretty consistent, pretty strong returns for September, especially with September is historically one of the worst months
Right.
of the year. And so seeing that I mean, we'll see if that kind of trend continues. I think that you mentioned, I mean, 59% of October's from 1950 to 2024 are positive.
Right.
It's a good thing
Right.
at the end of the day, right? So almost 60% hit rate. It's better than most. I mean,
Right.
we'll see how that kind of shakes out. But Miles, when we're looking on the other, so when we're looking at a little bit more in depth into the market movement, we track a lot of different participation indicators,
Right.
and so this is the second of the five kind of charts we'll look toward. We're pulling five different pieces from that quarterly weight of the evidence report to kind of highlight on the podcast today. If we look at, okay, what does the outlook look like from a participation standpoint when we're heading into the month?
Right. Yeah, we've seen a bit of a decline. Kind of, we typically think about participation in three different layers: near, intermediate, and long term. Now, when we say participation, a lot of you are probably familiar with it by now. But again, the kind of definition is what percent of a given universe holds a trait that we desire. So, for instance, the bullish percent for the S&P 500, what percent of the S&P 500 are trading on buy signals? That's going to be a good thing. So we want this number to be high. We've seen over the course of, kind of Q3, that number fall a little bit, right? So less S&P 500 stocks trading on buy signals. That's going to be a maybe a yellow sign, right? We're still elevated, but the point is that where that participation is coming from, where that upside action is coming from, is at the hands of fewer and fewer stocks. So this is, again, not a bad thing just quite yet, and we'll touch on why it's not necessarily a bad thing. But in the intermediate term picture is waning a little bit. But the long term picture, Ian, take it away. Not
Yeah, I mean, well, I think that chart's important. The BPSPX we're looking at there, we saw it fall at several points last year. It fell pretty far
yeah,
this year. I mean, we fell from what almost up near 80 down to 14%, if I'm looking at this chart correctly. For those following along on YouTube, we've found the charts up there, obviously, but um, fell down in the tariff tantrum down to 14%, very low territory, and got all the way back up to 74%. Falling back to 56%, not that big
yeah,
of a deal. I mean, we fell in April of 2024, we fell down to 50, climbed back up to 70, fell back down to 50, climbed up to 80. I mean,
right,
it's we typically see that kind of back and forth action in that upper mid field position.
right,
And when you carry that over, you mentioned intermediate to long-term trend. When you're looking at the percent positive trend, so what percentage of stocks in the S&P are in a positive trend? 72% right now.
right,
That's pretty good. More than two-thirds of the stocks in the S&P are still in a positive trend. Haven't seen that number change at all since July. It
right.
didn't change in August, didn't change in September, has not reversed lower, did not follow the other indicators lower. I mean, that's a sign of a lack of confirmation that we're seeing negative action from it.
Right. That long-term picture for a lot of these stocks, although we've seen a little bit more chop in the intermediate term, the long-term picture is still strong. I have two quick points. The first is that when we look at that PTSPX chart, most of our positive market action throughout history comes when we're trading above 50%. And like you just mentioned, we're over 70, which is even stronger confirmation. So again, that long-term PTSPX chart is still flashing green. And my second point is, remember, participation and performance can sometimes diverge, right? You think about 2023, there was a decrease in participation where we were below average, but for the most part, because it was dominated by just a handful of stocks, participation was low, but performance was high. So again, you can have again, divergence between these two. So even if we do see a divergence in the last quarter of 2025, it wouldn't necessarily be quite a bad thing. We need to see follow through for that to kind of take hold. Does that
Yeah,
make sense?
and important to keep in mind too, these are all looking at the S&P.
Right.
The stuff that's been leading, right? We've seen some improvement from some other areas of the market, especially on the small cap oriented stuff, since the rate cuts, right? So I think that'll be a pretty interesting point to monitor as we look forward toward the fourth quarter. Maybe we'll be talking about that in the Q1 2026 weighted the evidence.
We'll have to see.
Who knows? We'll see. One of the things we definitely will be talking about, though, as we continue to talk about in this piece, or in this report, each quarter is how's momentum done. And I
Right.
know you put some pieces together looking at the kind of classic, more not our implementation of momentum, but the classic 12 minus one oriented, like MTUM style. I mean, how does that typically kind of break out as we look at it on a quarterly basis?
Yeah, so using again MTUM as a kind of benchmark or proxy, it's had a pretty strong year so far this year, right? Momentum, excels when Leadership trends persist. That's largely what we've seen. Yeah, minus a handful of rallies for small caps and general areas. But point is, leadership trends have remained largely consistent over the last couple of years. Momentum outperforming or MTUM outperforming the S&P 500 so far this year. Typically, when it does so through the first three quarters, it's right on the other side of 50%, about 52 to 54% of the time it continues to outperform in Q4. So a little bit more than a coin flip. What's perhaps most important though, and again, we're throwing this up on screen, is how strong the fourth quarter typically is for momentum and also markets as a whole. Right. We take the historical average for MTUM again in that fourth quarter going back to 1993, just over 5.5% for Q4. And that's the best quarter of them all, leading the third quarter, which is historically the worst. And again, the second quarter, second best. That means that the first quarter is third best. But point is that momentum typically strong in the fourth quarter.
Yeah, and I think that plays into a lot of just the general end of year trends that we see. The
Yep.
fourth quarter, I mean, whether you're looking into UM or honestly any kind of major domestic equity index, we tend to see stronger performance in the fourth quarter. The stuff that has done well, and on the momentum side, stuff that's done well, people are trying to return chase, right?
Right.
They're trying to load the boat on things to make sure that their portfolios are aligned and intact with whatever's been leading the market at the end of the year. So they jump into those areas, and hey, what are those areas they're jumping into? Stuff that's done well. So
Right.
it pushes higher into the year. I mean, that makes sense when you think about it from that kind of
Oh
conceptual
yeah.
perspective.
People's jobs are on the
Of
line.
course, we just changed it. We'll see what happens from this.
Well, I was about to say we did get again third quarter historically one of the worst on average, but again we're playing a game of averages here, so it's not like we're ever going to really be on track with what the average really is. But we were better in Q3 than we historically have been. Fingers crossed. Here's to a productive momentum environment as we kind of move into the fourth quarter of the year and can get even better than average.
Yeah, and I mean when we're looking at okay, maybe let's separate that out and not necessarily look at how's MTUM done, but maybe just the individual security. So kind of like the participation of momentum, right? It could be another way to look at it. This is something John does a lot of work on. John Lewis, obviously the portfolio manager here, just kind of separates things out and looks at it. Okay, how do different quintiles of performance do? So if you take different momentum baskets, let's say you have the broad, I think it's what kind of top 1,000 names by
Right.
market cap, and you separate it out into quintiles of the top quintile five being the best performers, the bottom quintile one being the worst performers. How are those done from a participation standpoint? We've seen a lot of kind of parity in quintiles two through five. We've seen momentum do well, but we haven't seen, I mean, actually, the fourth quintile's done pretty well. The second's done okay. The third, not so much. The big story there, though, I think, is the bottom is far and away the worst performing, like kind of half the performance of the others at this point. So,
Yeah, no, I mean that's a really good point, and it reminds us a lot of us are going to be really focused on making sure that we're getting as many winners in our portfolio.
hmm
But the opposite side to that coin is, well, hey, listen, we can have the top 80% of stocks said otherwise, like the some of those guys are going to be laggards, right? The top 80 is just really another way to say the bottom 20. But point is that, what really matters is that we can avoid those weakest stocks and still have a productive environment for the rest of momentum.
Yeah. What about on the developed and emerging market side? Because we also look at the same kind of quintile spreads, obviously not the same indices. We're looking developed separately and emerging separately. Different momentum picture.
Yes, certainly. I mean, we've been talking at length in our research report on podcast about how productive the international market has been so far in 2025. Developed markets really have been the spot where you have a nice cascading effect down from the top down to the bottom. So there you have your really productive market environment for momentum strategies where your leaders, your second most leaders, your third most leaders, all of them are beating the bottom ranked stocks, your weakest stocks. So again, that's going to be an extremely productive environment for momentum strategies. A lot of that strength is coming from Europe specifically. But when you look at the emerging markets, this is actually a very interesting kind of pattern that we're seeing. The top ranked stocks doing very well. They're the kind of leading basket. The bottom ranked stocks also doing particularly well. A lot of that on the kind of bottom ranked stocks, China, has been a big laggard rally that we've seen from China over the last couple of months, kind of end of Q2 into Q3. We've seen that kind of persist over, and now we open up 2020 or Q4 2025 with that kind of picture, the kind of sandwich, if you will, of strength.
Yeah, and that's, I mean, the stuff is in the bottom until it moves to the top. Right? I mean, that's,
Yeah,
I think, an important thing, and John hits on this too, is that, yeah, when if stuff has been beat up so badly, like China has for a while up until this year, it needs to go through a period of outperformance before it can catch up and become a leader,
right,
right? And so that period of outperformance is going to mean that bottom rung, the laggard, because it has been a laggard, is going to pop. I mean, it's
right,
naturally going to move higher until it hopefully, and this is something that China has not been able to do in the past few years, has transfer over to that top rung,
right.
right? It's seen a pop and then it's kind of faded off, and seen a pop and then kind of faded off. Seems like it might have some staying power this time. I mean, we saw it was, I think, what the end of last year when the Chinese government kind of brought out the stimulus bazooka, as it was being called, and just tried to boost things up. And performance has been pretty well, especially in the more risk on oriented, the like China Internet, K Web, kind of from the crane share side. Stuff's been doing pretty well on a year to date basis. Seen a lot of strong performance from some of those names. So even though it might be a little bit, I guess, easy to throw targets at some specific Chinese representatives on the media side, at the end of the day, the stock's doing pretty well.
Oh yeah, I mean, you look at even in Dolly, right?
Yeah.
Our kind of broader rankings, international equities in second, and it's still behind domestic equities in terms of its long-term relative strength. But from a pure performance perspective, we're seeing some staying power up kind of towards the top of the rankings. And ultimately, just like you said, it's kind of put up or shut up time at this point because we've seen these rallies fall out of bed within kind of that 8 to 10 month period. That's about where we are right now for
Yeah.
international equities, right? So if there was a time where we'd start to see some rollover, or maybe it's here if we're playing again the historical averages game, but haven't seen signs of that just quite yet.
Yeah, and developed markets, I mean, still consistent from a momentum standpoint. It's kind of just seen a lot of sideways action though over the course of the more recent weeks.
Right.
And so you saw a lot of that strong performance front loaded to the first half of the year and not quite as much outperformance in the back half of the year so far. The thing you wouldn't want to see, obviously, is developed markets peter off and trail off, and then the explosion we've seen in emerging turn back around and move lower.
Right.
Then you get a quick international downdraft, which is kind of a lot of movement that we similar to what we've seen in prior years. If we need to see the emerging market space have those leaders move into the laggard or have the laggards move into the leaders, but you see a pretty wide spread right now from a straight fund score perspective between like the broader EEM versus EFA. I mean, you got almost a point and a half separating favoring EEM over EFA, both having suitable optimal fund scores. Pretty widespread favoring the emerging market side on that framework.
Yeah, I mean, and this makes sense, right? Because a lot of the emerging market strategies are going to be big overweights towards China. And so, just like you said, developed markets moving back and forth over the last month or so, China really rallying higher. That's going to, of course, bolster the fund scores and kind of a relative strength of some of these emerging markets. But like you said, I want to go back to this idea. Both of them are acceptable. You see if you look at the graph, EFA has a red score direction and a yellow fund score. It's near four. So if you add 3 point or 0.03 to that, it's going to be green.
It might even be out for this taking a couple days ago. Well, yeah, it's
Yeah.
been kind of petering around that fourth score line.
Yeah, so just again, the image that you're seeing might frame it as developed markets aren't doing as well, but both of them are strong. Let's put it that way.
Yeah, yeah. So they're certainly stronger and more consistent than they have been in prior years. Should be a pretty interesting point to watch for over the next 3 months. Hard to believe we're in October.
I know, man. It's
Yeah,
crazy. It just time's flying, huh?
it is. It is. What are you going to be for Halloween this year?
I don't know. I don't know. We're gonna have to figure that out. Typically, I have, a fun costume that I'll do. But I don't know. I haven't put a lot of effort into it this year.
Well, at least
Yourself?
you got 30 days to figure it out.
Yeah,
So
that's true.
we'll figure it out. Yeah, I'm right there with you. Cool. And you got any other charts that you want to run through?
No, man, as always, it was a pleasure to jump on with you today. And if you got any questions about what you're seeing at the end of the quarter, specific positions, you want to jump around the website, feel free to give us a call, shoot us an email. We're always happy to help out. Otherwise, wrap us up.
Yeah, I think we should begin. I mean, so this weight of the evidence report's coming out today. It'll be out on the research platform which is, as we've mentioned before, you can access that for free now. So just log into the platform, you can check out the report there. We also, by the time this podcast comes out, likely going to have Miles likely would have wrapped up the wonderful webinar that he's going to be doing tomorrow with John Lewis on our portfolio management side, Phil McIntosh on on Nasdaq's chief economist, and then Yanni's joining too, right?
Yes.
On the more kind of fundamental markets view side of things. So it should be a great conversation. That webinar is going to be October 2nd, but we're going to have some information about that in the report afterwards too. If you want to see a replay of that webinar, get that conversation, I'm sure it'll be available there too. So even though you won't plug yourself, I'll give you a plug.
Appreciate it.
Cool.
And appreciate y'all for listening. And we'll be back again next week to touch on any updates. Thanks, y'all.